covered this. My name is Whit Ford. I'm a mentor with SCORE here in Southern Maine. And my background is all over the place. I've been treasurer for a couple of nonprofits. I've worked in industrial marketing. I've owned my own company for 25 years. I've done a lot of things, but never for necessarily terribly long. So it's been interesting. And I've been with SCORE for about 6 years now. So Steve, you want to introduce yourself?
Sure. Steve Robinson. I'm a CPA, been in the accounting business for many, many years. Had my own accounting practice, worked with primarily small businesses and nonprofits, and have been a SCORE mentor for, I think, maybe 7 years.
So we all bring our own perspective to things, and we may not always have exactly the same responses to any given question, but that will probably help inform your thinking as well. So do interrupt us if you have questions, because it's best to get them answered when they come to mind. So don't hesitate. So I just spotted a typo, I'm embarrassed to say, in our slides, but I can fix that later. Steve, you want to dive in here?
Sure. Basically there are two accounting methods a business can use. Either the cash method, where revenues are recorded when the money is actually received and expenses are recorded when they are paid for, or the accrual method. The accrual method recognizes revenues when they are earned, and expenses are recorded when the goods have been received or the service has been performed. For tax purposes, taxpayers generally have the ability to choose the accounting method they want to use. And there are reasons to use either one of them, depending upon the type of business you're in.
So there are three basic financial statements that you've probably already seen in your businesses: your balance sheet, your income statement, and your statement of cash flows. Your balance sheet provides a description of what your business owns and what it owes. And the thing that's important to realize is that what you see applies only at a specific point in time. It also shows how much equity you have in the business, and that is usually of great interest to many owners. And equity is defined to be the difference between what your business has, its assets, and what it owes, its liabilities. If you take the difference, what's left over is your owner's equity. That can be positive, and in some cases, that can be negative too. Your income statement.
I just want to, Rick, can I just jump in there?
Yeah.
I'm just going to say the equity does not have any relationship to the value of the business. So
good point.
Equity is not intended to show what the business is worth.
In general, the worth of the business is based on the cash flow you're expected to generate over the next few years. And what got you to this point that may have resulted in profits or losses has no relevance necessarily in that analysis.
Yeah, so. In the case of Chauncey's business, the big asset that you won't recognize until you sell it is the value of the real estate.
Right.
So.
And that gets tricky because in your balance sheet, your real estate is carried at cost, not at value. And so what you see in your balance sheet doesn't shed any light on that. We have a new person that's joined us. Christian, did you wish to introduce yourself briefly and give us a sense of what business you're in?
Hi, can you hear me?
Yes, we can. Thank you.
My name is Christian Bittai. I'm actually a finance director on demand, and I offer accounting and finance services, no tax service, but more like closing your books at the end of the month. I specialize in the hospitality industry, but I have knowledge of other industries, and so I just wanted to see how the important topic of profit and bank balance was presented by Score.
Okay, well, welcome. Do jump in with questions should they arise. So
Wonderful, thank you.
So the second major income statement, sorry, second major financial statement is your income statement. The major difference is that it shows a period of time, not just a single snapshot in time. And so, whereas a balance sheet is a report as of a specific date, an income statement is a report between two dates. And it shows the income and expenses that were incurred by the organization between those two dates. And the final statement is a statement of cash flows, which shows a change in a business's cash balance between two dates, just like the income statement does. However, and the whole reason for this workshop is that what your cash flow statement shows you is often a very different number than what your income statement shows you. And both are important to your business, but your cash flow is critical to your business. So your income statement answers the question, essentially, did I make money? Was I a profitable business? It does so more so if you use an accrual approach than if you use a cash approach for many businesses. For some businesses, a cash approach is fine and the income statement is perfectly accurate for them. But for others, not so much. So the cash flow statement helps companies, particularly those that are using accrual accounting, to see what's happened to their cash balances and explain why they have changed as they have. And cash is important because if you run out of cash, that often means you can't pay bills, which means you're bankrupt. So we wish everybody to avoid that. Thank you. So, Steve?
Okay, so here's a sample balance sheet. And this balance sheet is showing balances as of 12/31/2022 compared to 8/31/2023. Balance sheets are broken down starting with assets, liabilities, and then equity. Assets are further broken down between current assets, fixed assets, and other assets. Current assets are defined as cash or assets that are expected to be turned into cash within the next 12 months. So for this particular balance sheet, as of 8/31, the company had $35,000 in the bank. Customers owed it $130,000 and it had $150,000 in inventory. So in this, you can tell just based on these balances that this balance sheet is an accrual basis balance sheet for the company. So the company has total current assets of $315,000. And then it has fixed assets, which are machinery and equipment that have useful lives over a year and are written off over via depreciation over their expected useful life. And so the company has purchased $625,000 worth of equipment. It has depreciated that equipment to the tune of $500,000. So there's a net fixed asset balance of $125,000. And then other assets are just miscellaneous assets that in this case we've got security deposits, so they were renting some space and they had to pay a security deposit. They also put a deposit to purchase a building, and so there were $17,500 in other assets. And then if you add up the three subtotals, you get total assets of 457,500. The liability and equity section of the balance sheet starts with current liabilities. And current liabilities include accounts payable. Those are bills that the company's received that are outstanding as of August 31st. This company also has a line of credit with a bank, and the balance outstanding on the line of credit is 150,000. So the company has total current liabilities of 225,000. Now, when looking at the balance sheet from an analysis point of view, one thing that I would look at is the difference between current assets and current liabilities. And that gives one an indication of the company's solvency and its ability to pay its bills. And so this company has about, I guess that's $90,000 net. The difference between current assets and current liabilities is 90,000. So company looks like it has plenty of liquidity to carry on its operations.
Chauncey has a question.
Yes, Chauncey.
Yeah, I've seen this before where the accumulated depreciation is listed here under the fixed assets.
Yeah.
And this is something I'm a little bit familiar with because obviously with real estate, I depreciate the property every year.
Yeah.
And then so I'm trying to understand the accumulated depreciation because you carry that forward. And I guess I'm trying to understand why is that listed as an asset? Because I think when I sell the property, then that accumulated depreciation actually kicks in at the sale. So I don't know if you can touch on that a little bit more to help me understand it better.
Yeah. So first of all, it's not an asset. You'll notice that 500,000 is in brackets. So that's actually reducing the fixed asset balance of 625,000. Okay. And basically what accumulated depreciation, say you take a building just for the heck of it, say you paid 100,000 for it, and it's got you're going to depreciate it over, just for an example, this isn't really the life you'd use, but 10 years. Okay. So you use a straight line basis. So you just divide the cost of the building 100,000 by 10, and you get 10,000. That's going to be a depreciation every year. So in year 3 of owning that building, you'd show the building asset at 100,000 and accumulated depreciation of 30,000 for a net of 70,000. When you go to sell, what happens is, and let's just use this balance sheet for an example. Let's assume that this was just one building that this company owned. When it calculated the gain or loss on the sale of the building, you would take the sale price minus the net fixed asset here, the 125,000, and that would be the gain on the sale.
And it's also important to remember that land is not depreciated, only buildings are depreciated.
Did that answer your question, Chauncey?
Yeah, it does. Thank you.
Yeah. Okay. Moving down to the long-term debt, long-term liabilities, long-term debt, that could be a mortgage. Long-term debt is any debt that's payable over more than 1 year. So on this balance sheet, when you add the current liabilities to the long-term debt, you've got total liabilities of 345,000. So the equity in the business is going to be the difference between the total assets of 457,500 and the total liabilities of 345,000. Now the equity section is broken down into different categories, and the first item that you see under equity is paid in capital, and that's the initial investment that the owners made in the business. Retained earnings are the accumulated profits that the company has realized over the life of the business. Draws are distributions. Now, this could be either a sole proprietor or an S corp. And the draws or distributions are monies that the owners have taken out, not as salaries through payroll, but as simply writing themselves a check. And you might be look at it similar to if you had a publicly traded stock investment, they paid dividends. Dividends would show up the same way you see the draws and distributions here. And then the last item you see there is a current year income. So through August 2023, from January 1st through August 2023, the company has earned $60,000 in profits. And so the total equity of the company is $112,500. And because the balance sheet by definition has to balance, the total liabilities and equity equal the total assets.
So that's a balance sheet. One thing that we're often looking at as we look at financials is trying to see what's changed and, more importantly, why. And so the right-hand column shows you a dollar difference between the end of last year and the end of August this year. And one of the things I do when I look at a balance sheet is I quickly scan down the dollar or percentage differences and make sure that all the changes that I see make sense to me from what I know about the operations of the business. Just because something changed doesn't mean it's bad. It's only if it changes in a way that surprises you that means that you probably need to do a little research to understand why it changed and whether it is good or bad.
Yeah, and another thing, in looking at the balance sheet, what I look at is accounts like accounts receivable, inventory, accounts payable. Accounts receivable and inventory are assets that a company has invested that are not cash. And to the extent that you can, in order to maximize cash flow, you want to manage your accounts receivable and inventory to keep them as low as reasonably possible based on the type of business that you're in.
Yes, Chauncey.
Can you touch on retained earnings again one more time? Is that just maybe like income that was earned in a previous period?
That's the income that's been earned since the inception of the company. So those are all the profits for all the years the companies have been in business combined.
Now,
Okay. It's an accumulation of kind of the income then.
Correct.
Right. But if you're the owner and you've paid yourself a salary, that would have reduced those profits. If you're an owner and you took a draw, you weren't paying yourself a salary, but you took a draw, that would be taxable to you on your personal income tax return if it's money that you're taking out that was in excess of the capital you invested in the company, i.e. profits on what you invested. But it is possible to a point to take out money that you'd invested previously. And since that was after-tax money you invested, it's after-tax money that you take out and you don't owe any taxes on it, but it would reduce your paid-in capital at that point. So moving on, our next example of a financial statement is a bit shorter. The income statement, as I said earlier, shows you the results over a period of time. And it has two major sections, revenues and expenses. Under revenues, you list the receipts. Sometimes they are broken out by different lines of business or different product types. Oftentimes they are not, in that you might rely on your accounting software to give you that breakout if you wish it, but on your financial statements, you just wish things to be short and sweet. Immediately after that comes something called either cost of goods sold or cost of sales. It means the same thing. And these are the out-of-pocket costs that you experienced to produce the goods or services that were sold for the revenue. So if I'm selling something out of inventory, cost of goods sold is the cost of acquiring that and or storing it until I sold it. If I'm selling services, say I'm a consulting firm, then cost of sales could include the payroll paid to the people doing the work for that contract or those contracts. There are many other costs other than the direct costs of what was sold, and those are what follow. But for now, we take our revenues, subtract cost of goods sold, and end up with gross profit. The gross profit is universally recognized as the number that represents the money you got from operating your business after paying the most direct costs for selling the product or service that you just sold, but before all your overhead costs and a bunch of other costs that may also vary with your sales. But so those other costs all come under operating expenses. And what follows, wages is typically a huge percentage of them, but the wages that you see down here are often wages of people who are not necessarily directly involved in making the product or service that was sold. So these would be administrative wages, bookkeepers, managers, salespeople. Salespeople are not considered a cost of goods sold. So if you pay somebody to help you sell, whether it's on commission or salary, that's down under operating expenses, not under cost of goods sold. Depreciation, mirroring what you see on the balance sheet. The depreciation here will be the amount of depreciation incurred over the period you see at the top of the income statement. And at the end of the year, this number will match the number that you see as what was added to total depreciation for the year on the balance sheet. And then other operating expenses, in this case, it could collapse 5 or 10 or 100 different smaller expense accounts, you know, things like electricity, oil, gas, insurance, paper clips, pencils, you name it. If you're a small company, you probably are going to show a whole bunch more accounts here because they're of interest to you. If you're a larger company or an organization such as a nonprofit who's giving your financial statements to a board or to an outside bank or an outside investor, you might not want to show a ton of detail under these smaller expense numbers because showing detail invites questions, and you really don't think that those people have any business diving into these minor expense items. Add those all up, you get total operating expenses, subtract that from gross profit, and you get net income. And net income is exactly what you'll see under the owner's equity section of your balance sheet.
And I just add with, when looking at the gross profit, often looked at as a percentage of revenues. And so in the case of this income statement, the gross profit margin is 30%. And depending upon what industry this particular business is in, that gross profit margin might be good, might be bad, or might be what you would expect. But it's one of the key things I look at when I look at a P&L is what their actual margin is.
So we now get to the central topic for this workshop, which is cash flow. And in general, cash flow refers to the cash that's been generated or used by the business over a specific period of time, just like the income statement looks at a specific period of time. The primary value of cash flow is that it explains why your bank balance changed as it did. And for business that uses accrual accounting, your income statement will often not change by the exact amount that your bank balance changed. So we're going to warm up and explain the third financial statement in the statement of cash flows. And to do so, you need to have started by understanding the balance sheet, the purpose of the balance sheet and of the income statement, because those two statements together are what help us come up with a statement of cash flows. So, Steve?
So when calculating cash flow, profit or losses are in most cases the most important factor. So, if a company's showing a profit, then hopefully that profit does transform into positive cash flow. If it's showing a loss, the expectation would be there would be negative cash flow, but in both cases, depending upon the changes in the balance sheet accounts other than cash, will determine what actually happens to cash flow after taking into consideration the profit or loss. So the way it works is an increase in assets other than cash reduces cash flow. So for example, if you're a company that has inventory, when you say buy whatever you might buy, let's say you're sell tires and you buy a bunch of tires, that doesn't get expensed on the income statement until you actually sell the tires. So when you purchase them, you account for them as an increase in inventory, and the corresponding decreases in cash. An increase in liabilities, and let me just back up for a second. So an increase in an asset reduces cash flow. A decrease in an asset increases cash flow. So another example would be accounts receivable. If you have a company that bills its clients, the accounts receivable balance, if it increases, is a reduction in cash flow because the sales have been recorded on the income statement, but the business hasn't actually received the money from the customer. If receivables decrease, that means that customers have paid more on their accounts than you've actually billed them for during the period that the income statement is being shown. And so that has a positive impact on cash flow. Liabilities are just the opposite. An increase in liabilities is an increase in cash flow, and a decrease in liabilities is a decrease in cash flow. And so, for example, accounts payable, which is, probably the most common liability, when you buy something and you buy it on account, when you buy it under the accrual method, you record it as an expense when you received whatever it is you bought, and you might have, say, 30 days to pay for it. So that would increase your liabilities, and it has a positive impact on your cash flow because it's been expensed on the income statement, but you haven't actually paid for it. And another example would be a bank loan. When you take out money from a bank, it gets recorded as a loan, a liability on the balance sheet, and the initial borrowing from the bank increases your cash flow because say you borrowed 100,000, you put 100,000 in the bank and you owe the bank 100,000. That's a liability, so that's a positive impact on cash flow. Then when you start paying the mortgage, the principal amount of the mortgage reduces the amount you owe the bank, but it does not show up on the income statement, so it has a negative impact on cash flow.
And that's an important point to emphasize that a lot of people are uncertain about, that when you make a mortgage payment, the interest portion of that payment is an expense on your income statement, but the principal portion of your payment is not an expense on your income statement, even though it reduces your cash.
And then equity, increase in equity has a positive impact on cash flow. Decrease in equity has a negative impact on cash flow. Increases in equity are typically a result of owners putting more money in the business or their initial investment. Decreases in equity are typically going to be distributions or draws that the company pays to the owners. And distributions and draws are not expenses on the income statement, but they do reduce your cash balance, so they have a negative impact on your cash balance and cash flow.
So the balance sheet has a huge impact on cash flow, in part because the whole process of calculating cash flow, as you'll see in a minute when we show you a cash flow statement, starts with the bottom line from your income statement. How much income did you generate? But then, following all the stuff that Steve was just describing, that number from the income statement has to be adjusted for the changes in just about every single balance sheet account that's occurred over the period. Now, that can get extremely detailed, but for most people, there are a few accounts which tend to lead to most of the changes in their cash balances compared to their profits. And so even though technically you do have to look at every account on your balance sheet, and that's what the report out of your accounting software will do, if you just want to come up with a quick analysis, you don't need to look at every account, just the ones that had big changes, and that'll probably get you into a ballpark calculation of your cash flow. Anyhow, so Steve, do you want to take us through these?
Sure. So starting with depreciation, again, depreciation is the write-off of equipment that's been purchased previously. So it's referred to as a non-cash expense. It does show up on the income statement as an expense, but there is no cash outlay associated with it. So when looking at the cash flow statement, you add back the depreciation to the profit or loss that shows up as a starting point of calculating the cash flow. The next item is capital expenditures. And again, this is equipment, real estate, land that a company might purchase. Those types of purchases are not expensed immediately when they are bought, but written off over time via depreciation. So a increase in capital expenditure is a reduction in cash flow. And then debt and equity, changes in financing, whether it's debt or equity. If your debt increases, that means that you borrowed money, so that increases your cash flow. If your debt decreases, that means you paid it down, and that has a negative impact on cash flow. And again, this is principal payment of debt, not the interest. And so the principal payment does not show up as an expense on the P&L. So it has to be adjusted on the cash flow statement to get to cash flow. Changes in inventory, the same thing. If inventory increases, that has a negative impact on cash flow. If it decreases, it has a positive impact. And, one of the things that, I do when I'm looking at a statement or working with a client, I look at inventory and accounts receivable. And, if the company is, say, struggling with cash flow, or the balances seem high or whatever, those are areas where a company might be able to manage their inventory and receivables in such a way to optimize their cash flow. So accounts receivable, again, when you sell something to a customer that's going to pay you sometime in the future, that increases your accounts receivable balance. The sale itself shows up on the P&L. So the increase in the accounts receivable reduces cash flow. And by the same token, once the invoice is paid, that reduces accounts receivable and has a positive impact on cash flow. Accounts payable, again, when you buy something on terms, you expense it when you buy it. You don't pay for it till sometime in the future. That has a positive impact on your cash flow, and vice versa. When you actually pay the bill, it has a negative impact on cash flow. And then the owner draws of distributions are items that don't show up on the income statement, but they are a use of cash. So you have to take them into consideration on the cash flow statement, and they have a negative, for lack of a better way of saying it, impact on cash flow. And whether it's negative or negative doesn't necessarily mean it's bad. Especially when it comes to distributions, because if a company has the ability to pay draws or distributions to its owners, that's typically a good thing. And then there's the change in any balance sheet account other than cash will have an impact on cash flow, but the ones mentioned here are the more significant ones, the typical ones you'll see on a cash flow statement.
So here is an example of a cash flow statement. Once again, it starts off by giving you a period of time over which this statement covers. And it starts off with a section called cash flow provided by operations or operating activities. This is, by convention, the first section of the cash flow statement. Some businesses will have more sections than others. It depends on the nature of the business and how many different types of activities that they have had over this time period. So, as Steve explained previously, we start with net income. This is exactly the number that the income statement showed.
And that
the number
that typically is the most important item to generate cash, is make a profit.
Now, if you think back to the income statement, the bottom line of the income statement had subtracted depreciation to arrive at that bottom line. But in reality, depreciation is a non-cash expense. It's expense on your income statement to reflect the cost of purchasing an asset a while ago. But you didn't actually shell out that cash this year for that asset. So the first thing that happens to the net income amount is you get depreciation added back to it so that you get back to a pre-depreciation net income number. And then we proceed to go through the changes in all of the accounts that Steve just took us through that increased or decreased over the period in question to get at a total cash provided by operating activities. Now, the accounts that are not included in here are changes in debt levels, changes in equity investments, and so on. So if you invested more money into new buildings, or if you sold a building, that would generally be down under investing activities, not up under operating activities. In your case, Chauncey, the operating activities would be rental income, rental expenses, and any changes in the balance sheet for the rental activities. Next, you get the cash flow used by investing activities. This would be purchase of new equipment, sale of old equipment. And so, for example, you might buy a new piece of equipment, that's a cash outflow, and so you list it here at your cost. However, if you sell a piece of old equipment, you probably are going to realize a gain or a loss on the sale, depending on what the depreciated value of it was compared to what you sold it for. And so that gain or loss on the depreciated value would be recorded here on the cash flow used by investing activities. If you're a large company and you buy and sell bonds or stocks, so on, of other companies, those sorts of gains or losses would also be reported here, but not just gains or losses. When you buy something, you don't have a gain or loss yet, but you bought it. So all the cash left to make the purchase, so it'll show here. It's only when you sell it that you record a gain or loss. Then financing activities, this could be from issuing debt or issuing equity in your company, or, for example, it could be some partners investing more cash into the company because the company needs it for growth. So any increases in debt will mean you have more money in the company, so that'll be a positive to your cash flow. Any decreases in debt, including paying down principal on existing loans, would result in a decrease in your cash and therefore a negative number on this statement. And then any owner draws or distributions will be money leaving the company going to owners. That's in effect pretty similar to a financing activity. So you take all of the activities pulled together, and so you take, in this case, 105 minus 30 minus 60, and you get to the net change in cash, which in this case is $15,000 more cash than we had on January 1. So the company has generated cash despite owner draws of 20,000. And usually that 15,000 number for the increase or decrease in cash is reconciled to the bank balances that were reported on the previous balance sheet and on the current balance sheet, just as a check and balance to make sure that, yes, this statement does accurately reflect the difference in cash that the company has between then and now.
And so just kind of to summarize that, so on the income statement, there was a profit of 60,000, but the cash balance only increased by 15,000. And these various items that you see on the cash flow statement explain why there's that difference.
Now, the good news is if you use some accounting software, that software, in all likelihood, will produce a statement of cash flows for you very easily. And that's wonderful because it saves you a lot of squinting at your balance sheet. However, I have found that the statement of cash flows sometimes does a beautiful job of answering the questions I have about why my company financials show what they show. And at other times, I have found myself feeling almost more confused after reading through the statement of cash flows because so many things have come and gone into and out of the company over the time that the simple explanation I was looking for as to why my bank balance changed as it did isn't there. It's actually a much more complex and nuanced explanation than I had been hoping for. So I say this just to say, if you ever look at your statement of cash flows and find yourself scratching your head, don't worry, you have lots of company. It takes a little time and effort to get to the point where you can sit back and feel that you really can explain to somebody else exactly why your cash increased by 15,000, even though your profits were 60,000. So any questions on that so far? Okay. So, Steve?
I think I pretty much kind of explained this, right?
I think so, yes.
Yeah.
So the major thing that I would just reiterate is that we've talked our way through a number of the accounts that account for the majority of cash flow adjustments that have to be made to the income for the year or for the time period. And these accounts tend to be the ones that, for most companies, have the biggest impact on the company's cash balance. So as an example, accounts receivable is something where you may have just gotten a huge order in from a great customer, but because they're such a great customer, you offered them terms of pay in 30 days. And so that sale hits your income statement immediately, and you show the profit from that sale, which is great, except that you haven't received any money yet because all the money is still sitting in accounts receivable. So that increase in accounts receivable decreases the cash you receive from profits until such time as that bill is paid. And at that point, you've received all your money from the customer and you have actually received the profits that you reported on your income statement. Inventory is similar. It's something you've bought, ready to sell. You've paid for it, the cash left, but you haven't sold it yet. So you haven't made any money on it. At the time you sell it, you'll expense it, usually in cost of goods sold, and that turns inventory into cash. So when your inventory goes down, your cash goes up. But it's a little more complicated than that, because remember cost of goods sold. You subtracted that immediately on your income statement, but you actually sold that product probably for more than what it cost you. So the cost of that was subtracted immediately. The profit from that was reflected down on the bottom of your income statement. So when we get to the statement of cash flows, we need to take your income, which includes the profit from that item, and add to it the cost of that item, because you're getting that money back at this point. The money that you had in inventory is turned back into cash. So the profit from the sale comes from the income statement. The recouping of your cost to buy it originally comes on the statement of cash flows. Accounts payable, same thing as accounts receivable, just the other way around. It's things that you've bought but not paid for yet. And if you can get terms from your vendors, that's a really good way to help you improve your cash flow by taking advantage of those terms. You buy something, you get it in the door, but you don't have to pay for it for another couple of weeks. You get the use of that cash for a couple of weeks longer than you otherwise would have. That's why an increase in your accounts payable is considered an increase in your cash flow. And then Steve talked about capital expenditures. They're not expensed in your income statement. When you buy something that has a life of a year or longer, in general, you are not going to expense it. You're going to capitalize it and then depreciate it over time. And so when you buy it, there's often no impact on the income statement immediately, but obviously all the cash to buy it left your bank account. So that's accounted for on the statement of cash flows. Then over the life of the product, you're going to take depreciation, but that's something that you didn't actually have to spend at that point. So we then add that back on the statement of cash flows. And in the end, it all works out. The statement of cash flows does describe what happened to your bank balance, but it's all coming from a combination of analyzing your income statement and your balance sheet. Similarly, funds raised, I think we've talked about this in all of its variations. And so this leads us to our conclusions, which is, first of all, that, as Steve said earlier, the bottom line on your income statement is generally the major part of most companies' cash flow during most periods. Not always, but that's the start to your cash flow calculation. And the profit you earned in this period obviously has usually a fairly significant impact on your bank balance. But that profit is not the only thing that changes your bank balance, as we've explained. And so you also have to adjust for changes in every balance sheet account except for cash. And the statement of cash flows is the canned report that comes out of your accounting system that offers you the complete explanation of everything that changed that might change your bank balance. In some companies, in some periods, this might be extremely different than what your income statement showed. For example, if you just bought a major asset or just sold a major asset. And yet other periods, your income statement might reflect the change in bank balance quite closely, and that's okay. The statement of cash flows is there to help you figure out, okay, what the heck happened this period that caused my bank balance to change by a different number than my income statement shows. Many times you'll find that you have a gut feel for it and you're about right. And so you can just look at your income statement, make a couple of quick assumptions, look at your bank statement and say, we're good to go. But at other times, you'll find yourself scratching your head. And those are the times where you should definitely look at your statement of cash flows to help you better understand why your bank balance changed as it did.
And when I was practicing and doing tax returns, I'd often have business clients when I got their tax return done, and they show a profit and they have some tax liability. They come in and say, I don't understand. Why do I owe taxes when I don't have any cash? And I'd go through the cash flow statement and explain to them what happened.
So why is all this important? Well, because as we said at the beginning, if you run out of cash, that can close your business. You need cash to operate. So we encourage you to project your cash flows over the next 6 to 12 months. Ideally on a sort of a monthly basis. If you wish, you can do it a quarterly basis. But by looking out, long enough, you can anticipate potential problems, hopefully with enough time to seek a source of cash, such as a line of credit from a bank, to tide you over a slow spot where your cash balances might get perilously low.
Or also help you strategize, I guess, things you can do to improve cash flow, like control your receivables better or control your inventory, that type of thing.
So I think you'll find the first time you try projecting cash flows, it's quite the exercise. It takes a while to think it all through. But having done it once, I think updating your previous cash flow forecast is a much faster project. And so once you develop the skill of projecting your cash flows, and you're not worrying about being right to the penny, you're worrying about being right to the, I don't know, nearest $1,000, maybe $10,000, depends on the size of your company. You just want to get a sense of, is my cash going up or going down over the next few months? And if so, is it a concern or not? Yes, Chauncey.
So this is probably a good time to ask this question. So if I find that I have a capital expenditure that I'm gonna pay early, but there's not enough cash in the business, and I'm just gonna infuse my business with more money from, my personal accounts, would that go in under the owner's contributed capital, or would I need to capture that separately from the initial investments?
You could just put it under, well, there's a couple of ways I might approach it. If you had taken any draws, I probably would first, any money you put back, reduce the draws. And then anything in addition over and above that, I would record as additional paid in capital.
So if you're looking for some tools to help you do cash flow projections, we have a couple of cash flow templates on our website. And when we send you the slide deck, you can click on these links here in the slide deck. You can also find them on the SCORE Southern Maine website under templates and tools. There's no one way you have to do this, so you don't have to use a template. You can use the back of an envelope if that does it for you. But a spreadsheet often lets you break things up month by month in a way that makes it easier to update a few months from now. And I do encourage people to update their cash flow forecast at least quarterly. Monthly is great, but some businesses are pretty predictable and don't need to worry about it. Other ones, particularly as you're coming your slow season or something like that, that's a good time to update your cash flow forecast and make sure that you've got a big enough cash balance to get you through your likely expenditures during the slow season.
And if the business is struggling, it's really important to try to project cash flow to figure out how you're going to continue to operate.
And if a business is brand new, forecasting not just how much money is going to be needed for startup expenses, but also looking at a 12 or 24 month cash flow projection gives them a sense of the total amount of cash they're going to need to get them to break even, which is often a very different number than their startup expenses. And people don't realize that until they look at a cash flow forecast. So I can't say enough about the value of cash flow forecasts to a business. Although you may think I have said enough at this point. So that's pretty much all of the content we had for you today. Any further questions? Well, we will send you a link to the recording of this workshop and the slide deck for you to look through if you want to review the slides or click on the links at the end there. If you want to see other upcoming workshops, there'll be links here on the slide deck to the 3 main chapters, depending on where in Maine you live. And the SCORE website will also help you find them if you just type in your zip code. And in case you don't know too much about SCORE already, we were founded in 1964. We offer free mentoring and workshops. We're a nonprofit and a partner of the Small Business Administration. And we have about 320 offices throughout the United States. People like Steve and me all volunteer our time to help people start and grow their businesses. It's fun for us. And it gives us a chance to learn a lot of new stuff ourselves every week. And that's why we do it. So it's interesting for us. And if you want to sign up for a mentor, if you don't already have one, you can scan this QR code and presto changeo. It'll take you to the screen, lets you sign up for a SCORE mentor. That's all we have for you today. Thank you very much for joining us. If you have more questions, I've got time to stick around. I assume you might have another few minutes, Steve. But we'll be happy to
Yep.
answer them. But if not, we'll bid you farewell for the day.
Thank you.
You're very welcome,
I
Christian.
have, oh, go ahead, Chris.
No, go ahead.
Okay, I didn't want to step on Christian if he was going to ask. So I had a question about, you mentioned taxes. When filing a like a Schedule K-1, would my CPA primarily obviously needs my income statement, right? Would my CPA also need to look at data from my balance sheet or from my cash flow statement?
Yeah, you're talking, if it's a K1, you're talking either a partnership or an S corp tax return.
That's correct.
And the CPA will need to know, will need to see the balance sheet and the income statement, not necessarily the cash flow statement. Things on the balance sheet that will be of interest to them are the distributions or draws that you take. Changes in your fixed assets, to pick up equipment purchases and that type of thing. So.
And many tax returns also ask for your total assets as of the end of your tax year. So
Yeah, and an S corp return requires a balance sheet, and I think partnership returns do as well.
So statement of cash flows, maybe they're interested in seeing it just to help identify things that happen a little more quickly. But since, as we went through, the statement of cash flows is entirely derived from the income statement and balance sheet, the accountant doesn't really need the statement of cash flows.
Yeah. And when I was practicing, again, I would look at the cash flow statement for kind of a sanity check. I come up with, okay, this is your profit, this is what you're going to pay tax on. And again, anticipating, typically my clients would come in and say, why don't I owe so many taxes? And then you can kind of explain, hopefully, to them. They don't always, still don't get it, but so.
Other questions?
Got kind of an oddball one just from an entrepreneurial aspect, not specifically related to this, but have you guys heard of the Corporate Transparency Act? And if you have, do you have any thoughts or insight on how that could affect small businesses?
I haven't heard of it at all. My guess, it sounds like something that would be more applicable to a big publicly traded company. So hopefully it wouldn't have any impact on small businesses, but I haven't heard of that at all. Where have you heard of it?
Yeah, I
The
saw
only,
it was actually, oh, I'm
Go ahead.
sorry, it was an article linked in a, I think it was a Schwab email that I got, talked about the Corporate Transparency Act and there's just more reporting, I guess, that's required for small businesses. They're trying to, I think, you're right. I think it was more targeted towards large businesses, but small businesses are also affected.
Yeah.
And it's just a federal reporting requirement.
my guess would be that they're trying to get at the complex structures that can arise where a company owns a company, which owns a company, which owns a company. And, who benefits from this or that in that string of companies is a question that often arises in law enforcement, as well as in, political contributions, et cetera. So my guess is it may be trying to help get at that kind of thing to clear up who benefits from the income of the company.
I'd be very surprised if it would impact, most small businesses. It might have some impact on the technical way you put together a financial statement. But
I mean, my not knowing anything about it, my first guess was that if you say had multiple LLCs, one for each property you own, that you might need to declare who is the beneficial owner of each of those LLCs. And that would probably be the only impact. But I'd have to go do a Google search and learn a little bit more to give you a
Yeah,
correct answer. That's just a guess.
Great, thank you.
Great. Well, thanks for joining us. Have a wonderful afternoon. And who knows, maybe our paths will cross again soon.
Yes, sir. Thanks, y'all.
hey, take care, Chauncey. Take care, Whit.
Thank you, Steve.
All
Talk
right,
to you
take care.
soon.
Yeah, bye.
Bye.